As you know, this morning, the president spoke to President Putin of Russia. They spoke at length, and the president released a statement following that conversation in great detail. I can also confirm that the president just recently got off the phone with President Zelensky.
Hello and welcome to the week ahead from Nomura Podcasts. I'm Dominic Bunning, head of G10 FX strategy in the Global Markets Research team, and today is Friday, the 14th of February. We're releasing this week's podcast on Valentine's Day, and while financial markets might not be too focused on love, they have been focused on peace. We heard at the top of the podcast from White House Press Secretary Karoline Leavitt about President Trump's conversations with President Zelensky and Putin regarding a potential peace deal really taking centre stage. While there is very little concrete detail at this point, markets have seen something of a boost from these developments, with Eurodollar trading up towards its highest level since late January, and European equities continuing to surge. We'll discuss what this might mean for the euro area outlook with George Buckley, our chief European economist. This positivity is, however, still being partially offset by the ongoing threat of US tariffs and by sticky inflation data in the US. President Trump announced levies on steel and aluminium imports on Sunday the 9th of February, which are set to kick in by mid-March, while he's also openly discussing the idea of reciprocal tariffs on a wide range of US trading partners. Ruchir Sharma from our US economics team will be here to discuss those factors and delve into what it all means for Canada in more detail. In between Ruchir and George, we'll be briefly popping down under to catch up with Andrew Ticehurst, who will preview next week's central bank decisions in Australia, New Zealand and Indonesia. So, with no further ado, let's get stuck in. This week we start in Europe with lots of signs of movement towards a potential Russia-Ukraine peace deal. George Buckley joins us to discuss the potential implications of this and some crucial upcoming UK data as well. George, it's maybe not the Valentine's date you were hoping for, but I do appreciate you spending some time with us nonetheless.
That's good to be on, Dom.
So this weekend we've got the Munich Security Conference, which a number of senior US officials are going to be attending. There's also been a lot of reports and Trump talking about his conversations with both Putin and Zelensky. It's boosted risk sentiment in euro in the short term, but from your perspective, what does this really mean for the euro area economy?
I think there could be some big positives here. First of all, the reconstruction, which of course could be positive for European firms, particularly in those countries where it's likely to come from. Look at Germany, for example, where construction has not been very strong over recent years. It could be very positive there. It could be positive for the currency as well, of course. And I think just generally in terms of risk sentiment, we know that, for example, the tariffs have led to a sizable deterioration in risk sentiment. And that can have a bigger impact on the economy than actually tariffs themselves. So this could be something which provides a positive boost, and it could even see energy prices fall as well. So I think from various angles, there's many things that this could be positive for Europe.
Yeah, I mean, we would agree on the FX side, certainly an upside risk to our views if that peace process does start to kick in. But you mentioned their tariffs, and obviously we can't really avoid that at the moment. As we're kind of recording this, we're scheduled a press conference from Trump regarding potential reciprocal tariffs on everyone else around the world, and Europe would probably be included in that in some form. So how much of a negative risk are the tariffs to Europe, and how are you thinking about that at the moment?
So we've previously estimated that the impact on economic growth could be around about a couple of tenths, and very similar to inflation as well on the upside. So GDP weaker, inflation higher. I mean, the only positive for Europe is that, of course, if the US slaps tariffs on Europe, it's tariffs which are on imports into one country, whereas if the US puts tariffs on Europe, it's probably going to do it to many other countries as well. So the impact on inflation in Europe definitely should not be as large as it is on the US. But I think you have to think about, as you pointed out in some of your research notes, Dom, that there are many reasons for why Trump wants to impose tariffs. One of them is to simply reduce the US trade deficit, and you can understand why. Against Europe, it's absolutely huge. It's over $200 billion a year. A second one is general fairness. This goes to the sense of if they charge us, we charge them. So the reciprocal tariffs, reshoring activity, the America First, the MAGA idea, and then addressing unrelated issues, things like NATO spending. Could this be a way of encouraging European countries to spend more on defence? But, combined with Ukraine, that could see a step up in fiscal spending. But tariffs themselves will be bad for growth. They'll be bad for global growth, not just European growth, because of the productivity repercussions. And I suspect that if they row back on those, or if they manage to find a solution or a reason to stop them, then of course that could be equally positive for both for risk sentiment, for the economy, and also for the currency.
Yeah, thanks very much, George. Well, there's a lot of cross currents there for Europe. I mean, the UK, if we move there now, there's also a lot of cross currents in the sense that inflation in some respects is still quite sticky, but growth has been quite weak. We've had a somewhat dovish Bank of England vote split at the last meeting. Then we've had an upside surprise to GDP, which maybe wasn't as strong when you looked at the detail. And we've got CPI and labour market data next week. There's a lot going on. How are you thinking about the UK economy at the moment, and what's your take on the data for next week?
Yeah, there is a lot going on. I think the two big reports for next week and the early part of the week are going to be the inflation print and the labour market print. And within the labour market print, the key question is what's going to happen to wages. Wage growth looked like it was moderating in the middle part of the year. Then the last couple of months, we've seen a significant uptick, and then it went back down again. So were those significant rises? Were they simply rogue data, and that we have gone back to something which resembles more normality? That's what the Bank of England's hoping for. On inflation, I suspect it's going to rise, largely because of base effects. But there's a lot of other things going on as well, whether it be from higher education fees to even higher bus fares in January. So lots of things which are announced in the budget or by the new Labour government, which will push up on inflation. And look at the Bank of England's latest forecast. They forecast 3.7% as a peak in inflation. That's a massive uptick relative to its previous forecast of about 2.5%. So we are going to see this in place for some time. This is not going to be a one and done. It's going to stay in the inflation figures for quite some time. And there's more to come as well. There's a lot of other single individual things that the Labour government announced, which we'll go through into tariffs. The one final thing I should mention, PMIs, of course, at the end of the week, and they are going to be important for giving us a steer on what's happening to demand, not just in the UK, but across Europe.
Great. Thanks very much, George. Appreciate having you on.
Thank you, Dom.
Now, moving to Asia, we're joined by Andrew Ticehurst. Now, Andrew, you often host the podcast, so you're in the opposite seat this week, but you've got quite a few interesting things happening down under this week. We've got the RBA and the RBNZ. What do you expect from the RBA this week?
Hey, Dominic, great to be with you. And yeah, exactly right. So RBA, we expect the gentle easing cycle to commence next week with a 25 basis point rate cut. That'll take the cash rate down to 4.1. I expect the board to note faster than expected progress in returning inflation to target. And that's really the driver of the decision. It's more that lower inflation allows monetary policy to be a little less tight. It's not a case that the economy is weak or falling over. Consistent with that, I think they'll sound a bit cautious, and they'll also say the inflation battle, while we've made progress, the job's not totally done just yet. So I think this will come across as a cautious and somewhat hawkish sort of guidance with that rate cut.
Great. And then the RBNZ's also next week. They've already been engaged in a cutting cycle. Do you expect that to continue as well?
Look, we do. And such an interesting compare and contrast between RBA and RBNZ. So RBNZ went harder. They hiked more and earlier, and their economy is much, much weaker, and now they're deep in the middle of an easing cycle. So we're pretty confident we'll get a third 50-bip rate cut from them next week. That'll take their cash rate down to 3.75. Activity data has started to turn more mixed. Some of the business surveys are looking a little better, but still, hard data is soft. GDP data is basically in a recession, and the unemployment rate's risen a lot. So I think there's just a strong first principles argument, particularly with fiscal policy tight there. Strong first principles argument just to get policy on the monetary side back towards neutral as promptly as possible. So yeah, we're looking for a 50-bip rate cut there. That'll take the cash rate down to 3.75. And we've got one or two more sort of penciled in further down the track over April and May.
Great. So sort of neutral somewhere just around 3% probably in New Zealand, and getting there a little bit quicker maybe than some of the other G10 economies. So certainly interesting developments. And the RBNZ often a sort of canary in the coal mine, I think, for a lot of the bigger central banks.
Exactly right.
Great. So apart from those two, we've, I think, got Bank Indonesia as well. So what do we expect there, and anything else we should focus on in Asia this week?
Okay, yeah, look, Bank Indonesia, let's stick with central bank theme. My colleagues expect BI to keep the policy rate unchanged at 5.75. Currency is an issue. The Indonesian currency has underperformed regional peers. And amid rising global trade tensions, which we're all watching, there could be some nervousness about further weakness in the currency there. Bank Indo did surprise with a 25 basis point rate cut in January, but FX stability does remain important. So on balance, we think it'll remain cautious and keep rates on hold there. In terms of what else is going on in the region, it's a little more second tier. I could note Reserve Bank of India will be releasing minutes from their February policy meeting. That could be a little bit interesting given the unanimous decision to cut at last meeting, and they do have a new RBI governor there. So if there's any kind of shift in flavour or thinking, that could be a little bit interesting. Korea will publish some export data that's really sort of caught up in calendar day effects, so that one will be a bit harder to interpret. But yeah, all up, I think those central bank meetings are probably the key things to look out for across Asia next week.
Great, thanks, Andrew. And actually on the RBI in India, I think very interesting currency issues there as well. We've certainly seen the currency come under some pressure, maybe a bit of pushback recently from the central bank to limit the degree to which the rupee weakens. But, we do think there's probably still some room for the rupee to underperform in the weeks ahead. So, yeah, certainly quite a lot going on in Asia. Appreciate your time, Andrew. Thanks very much and have a good week ahead.
Good one. Thanks very much.
We're close but not there on inflation. And you did see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress, but we're not quite there yet.
We finish this week in the Americas, and we have Ruchir Sharma from our economics team to discuss the latest US and Canada developments. Thanks for joining us, Ruchir.
Hey, Dom, it's great to be back.
So we've just heard from Chair Powell there, noting that the US is not quite there yet on inflation. And from where I sit, the data looks pretty strong. Labour market's resilient. We've got a hot inflation print for January. I guess you guys are pretty comfortable in your Fed call for no cuts in 2025.
Yeah, so data released lately that's been pretty supportive of our Fed call for no rate cuts this year. Powell, in his semi-annual testimony, reiterated the message that policymakers they're not in a hurry to cut rates, and Fed speak has generally echoed his message, especially given the uncertainty due to President Trump's combative trade actions. And to add on to it, cyclical upswings have continued well into the year. Consumption has remained strong. Labor market is solid. The Jan employment report was positive on net, with the unemployment rate ticking down. And in fact, Powell also noted in his testimony that strong backward revisions to the past couple of months suggest that there was a pickup in hiring. As for inflation, Jan CPI came in a touch above our expectations due to residual seasonality, certain service prices, and used autos. But we believe some of the strength is going to persist in the coming months. So although policymakers are cognizant about residual seasonality, the strong inflation report and risks of tariff-induced inflation is likely to keep them on hold in 2025.
Great. Well, the macroeconomy looks pretty solid, but we can't not talk about tariffs. The discussions are currently ongoing, and as we record this, we're seeing headlines come out left, right, and centre, particularly around reciprocal tariffs. We're obviously edging a bit closer to the March deadline for Canada and Mexico as well. What are you guys expecting in terms of tariffs in the near term?
Yeah, definitely. It's all about tariff these days. And so Trump's been pretty aggressive with his trade actions. And in fact, increase in the China tariffs, which is in place right now, alone makes this the biggest single tariff increase Trump has enacted in either of his presidential terms. So though the implementation of tariffs on Canada and Mexico has been delayed for a month, we think it's unlikely for both of the countries to be immune from his trade actions. And we think they'll be subjected to about 10% tariff rates. As for the steel and aluminum tariffs, which will come into effect on March, we think, again, the focus is on implementation. And the same is the case with the reciprocal tariffs. So now the thing to look onto is whether the countries could reach a deal to avert or get some conditional exemptions from Trump. And given the import share and tariff rates, and especially about steel and aluminum tariff, Canada and Mexico are at risk again, because Canada accounts for a majority of aluminum and steel that US imports and currently faces effectively a zero tariff rate. However, the impact from this is likely to be small on the margin if the blanket 10% tariff goes through as we are expecting.
Great, thanks. So, don't get too caught up in the headlines and I guess try and look at the signal rather than the noise in terms of what's really coming through. Obviously Canada's been quite a lot in the spotlight in terms of tariffs. Let's just focus on that a bit more. We do have as well Canada inflation next week. What do you expect from the inflation print? And more broadly, what's your view on what the Bank of Canada is going to do from here?
Yeah, so disinflation has actually been more pronounced in Canada when compared to its neighbor. The BOC's favored metrics to gauge price pressures, they've remained within their target range of 1 to 3% for 3 quarters now, and I think the January print is going to be no different. So measures of core inflation, they're likely to tick up slightly due to unfavorable base effects, but will remain subdued and well within the BOC's target range. And higher energy prices could push up the headline, but shelter inflation, which has been elevated for a while, is likely to come down. So what's important to understand actually about Canada's inflation is that excluding housing, headline has been below 1%. So the risks of inflation undershooting have increased. And again, January is going to be a noisy report due to the tax holiday thing, but overall, we think it's going to highlight that the disinflation trend remains intact. So that said, coming to the broader economic outlook, the picture still remains quite pessimistic. The Jan employment report was positive, but the labor market slack remains. Economy is still in excess supply. Per capita spending is way down. And again, concerns about tariffs, that's the key thing that the BOC is looking for at this point of time. Macklem has been super dovish, and he's noted that tariffs are already affecting business investments. And I think they're now focusing on how tariffs and how policy is evolving. So as I think now Canada is unlikely to be shielded from tariffs. And even in the case if there are no tariffs eventually, a long period of uncertainty could significantly impair business investment. So all of these factors cumulatively support our call that the BOC will continue to dial back the policy restraint, and they're going to cut twice in March and April.
Great, thanks, Chin. That's a bit more dovish, really, than the market's pricing, so it could be an interesting development there from Canada alongside the tariff story. Well, thanks a lot for joining us, Rishi, and we wish you luck following the president's social media comments and headlines in the next few weeks.
Thanks for having me.
That's it from the Nomura Global Research team this week. Thank you for listening to the Week Ahead podcast, which, as always, is produced and edited by John Dalton. If you're enjoying listening to the show or want to hear more from our economics or strategist teams, please like and subscribe to the podcast on Apple, Spotify, SoundCloud, or wherever you get your podcasts usually. We'd love to hear your feedback, for better or worse, so please leave a comment and share the podcast with anyone you think may be interested. You can also visit nomuraconnects.com to keep up to date and to keep on listening. Thanks very much, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, One Investment Bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.